Welcome to the debate. Our focus today is on a massive structural transformation happening right now in the Spanish residential property market. We're seeing this unprecedented influx of institutional capital. We're talking about major investment funds, companies that are really redefining housing as a dominant financial asset. And this movement, which has been particularly pronounced throughout 2025, is fundamentally reshaping who owns housing in Spain and really for what purpose.
Right.
So the central question for us is pretty profound. Does this record influx of institutional capital, does it primarily represent a vital economic opportunity, maybe a necessary stabilizing evolution for Spain's financial landscape, or is it fundamentally a detrimental force that just exacerbates housing challenges and, systematically undermines individual home ownership? I'll be taking the position that this capital inflow is actually a positive sign of market maturity. It brings stability, liquidity, and, critically, a necessary supply of rental properties.
And I'm going to argue that while, yes, capital is certainly flowing in, the costs that come with this shift, the erosion of market equity, and the acceleration of a very real affordability crisis are overwhelmingly borne by ordinary citizens. I think this entry by institutional players is fundamentally detrimental. It prioritizes pure profit motives over, the social function of housing and any kind of long-term community stability. We're really debating whether this is stabilization or if it's just market capture.
Well, let's look at the sheer scale and the rationale behind this shift. I mean, the rise in corporate buying is not a temporary trend. It signifies a robust and attractive and a maturing market that's finally pulling in the deep pockets you need for true scale and efficiency. This liquidity, and by that I mean the ability for the market to trade assets quickly, reliably, is just essential for any healthy, functioning economy. We tracked over 21,000 homes purchased by companies in 2025 alone. That is the highest volume ever recorded, which shows an extraordinary conviction in the market's future.
But conviction for whom?
Conviction for the Spanish economy. I mean, this activity isn't random, it's highly strategic. These funds are looking at Spain's political and economic stability, especially relative to many other EU member states, and they see a safe haven. In an environment where, traditional financial products offer very low yields, Spanish property offers both attractive long-term returns and a hedge against inflation. This continuous capital inflow ensures sustained liquidity, and it keeps the market moving. And what's more, and this is a crucial social benefit, these corporate buyers contribute significantly to the rental housing stock. They are directly tackling the chronic shortage that plagues major urban centers like Madrid and Barcelona, and now it's expanding rapidly along the coastal regions.
I have to say I fundamentally disagree with that framing of stability. You call it robust growth. I call it a systematic affordability crisis driven by pure profit motives. We really need to look past the big macroeconomic narrative and focus on the ground truth for private buyers. The evidence of distortion is, it's explicit in the transaction data. Institutional buyers are not just participating in the market, they are actively paying a massive premium, signaling a willingness to just outspend private individuals because they have a totally different cost of capital and different investment horizons.
Okay, but how significant is that premium exactly? We need some precision here.
Precision is the key, you're right, and it's the key to understanding the whole problem. So, institutional buyers paid an average of 2,347 euros per square meter, and they were acquiring larger properties too, averaging about 136 square meters. Now compare that with the individual private buyer. They paid a substantially lower average, 1,887 euros per square meter for smaller homes, typically around 113 square meters.
Right, so that's about a 25% difference in price per square meter.
Exactly. We are talking about a disparity of over 400 euros per square meter between corporate money and private savings. This isn't just a casual price difference. This disparity fuels intense upward pressure on overall housing prices. And the consequence is clear in the general market. The average resale housing price surpassed 2,600 euros per square meter in November 2025. That spike represents a severe 16.1% year-on-year increase.
When capital comes in willing to pay a 25% premium, it just drags the entire market up with it, making it extremely difficult, if not impossible, for first-time buyers and young families to enter the market at all. This is asset capture. It's not market evolution. I have to press you on this concept of efficiency. When we see a 16.1% annual price explosion in resale homes, how can we possibly argue that the market is prioritizing anything other than maximizing corporate profit? These institutional buyers are targeting the very same highly desirable assets, prime locations, properties with high rental yield potential that private buyers need. They bring superior financing, bulk buying power, and, proprietary data analysis. It's like bringing an armored tank to a bicycle race. The market competition is fundamentally and structurally altered for households who just cannot compete on those terms. The effect is a permanent removal of suitable housing stock from the reach of the middle class.
I see why you focus on that divergence, but I would argue that your analogy, it oversimplifies the nature of the assets being acquired by institutions. That price divergence isn't just arbitrary overpayment. It reflects the corporate targeting of a specific high-end or sometimes even high-risk asset class. I mean, often these larger, better-located homes require significant capital outlay for refurbishment or energy efficiency upgrades or complex legal restructuring, investments that individual buyers are either unwilling or unable to make.
But whether they are renovating or not, they are still removing viable housing from the individual buyer pool.
Well, they're targeting properties that maximize return and minimize long-term risk for their investors, which, yes, requires them to pay the market rate for premium assets. But this willingness to pay higher prices is not distortion. It's a function of a favorable legal and fiscal framework that Spain established precisely to attract necessary foreign investment. To characterize this as simple distortion overlooks the signal it sends. Global capital recognizes Spanish assets as stable, valuable, long-term holdings. It's a validation of Spain's economic planning. Let's pivot back to what I see as the most tangible and necessary benefit here: the impact on the rental market. Even if we can see that there is upward price pressure on purchases, which I'll grant you is the inevitable side effect of high demand in a stable, desirable economy, we have to acknowledge the overriding benefit of increased rental inventory. Institutional buyers, by their very nature, rent out properties rather than occupying them. This fundamentally addresses the critical limited housing supply and the soaring rental demand that has been a defining social challenge for years.
I'm sorry, but I just don't buy that the simple increase in volume of rental units automatically translates into a social benefit or increased affordability. That view entirely misses the social cost that's inherent in that efficiency.
But it gives people options. In cities like Valencia or Malaga, where rental supply has been choked for years, this institutional push provides units that just wouldn't exist otherwise. Without this capital, that necessary rental stock, especially high-quality professionally managed stock, it simply wouldn't materialize at the scale and speed required to meet explosive population demand. We are moving from a fragmented, small-time landlord model to a professionally managed one, and that brings better standards and greater supply security.
Professional management at a professional price. This is the crucial disconnect. Corporate buyers operate under a strict fiduciary duty to seek the highest possible returns for their investors. That profit motive translates directly into increased, often maximized rents. They know exactly how much the market will bear in strong demand areas, and they push that ceiling higher every single quarter.
But that's the definition of a market reacting to demand.
It is the definition of a market prioritizing yield maximization over, say, a public service. We see this paradoxical effect where the supply of rental units increases, the availability is there, but the affordability shrinks at the same time. This institutional presence risks solidifying permanently high market rents, making it increasingly difficult for working families to secure housing, even if more units are theoretically available. You are solving a supply problem by creating an affordability catastrophe.
Not the rejection of essential capital. The capital itself is neutral. It is how the market is regulated that dictates affordability.
But the capital dictates the market realities. Let's move beyond the immediate financial impact and consider the long-term social and regulatory consequences of this ownership shift. When ownership gradually moves from established resident homeowners to these distant anonymous investment funds, the character of neighborhoods transforms fundamentally. We see a prioritization of short-term rental profitability, or quick flips, over long-term community stability and local engagement. I mean, who is ensuring the local school is supported? Who is maintaining the street? The incentive structure for upkeep and local investment changes entirely when the asset owner is a corporate entity in Luxembourg or New York.
You're painting a picture of absentee ownership, which isn't necessarily accurate for all institutional investors. Many large funds require rigorous local property management just to protect their assets.
But the data suggests a reason for concern. The state is already raising red flags. We know of the public inspection campaign, a massive undertaking seeking to check 12,000 investment-owned homes for habitability and standards over the next 2 years. The government would not launch such a large-scale intervention if they were completely confident that these institutions were inherently superior, efficient custodians of housing stock. This campaign suggests that the quality of stewardship and compliance with basic habitability standards is already a serious regulatory concern linked to mass investor ownership.
That's a compelling point regarding the necessary adaptation of regulatory scrutiny, but I would frame that scrutiny not as an indictment of the investment itself, but as a necessary and mature response to a growing market sector. When 21,000 homes are purchased by companies in a single year, the regulatory environment must evolve to keep pace. We should praise the state for adapting its framework to ensure standards are met, regardless of who owns the assets.
But the need to check 12,000 homes in 2 years suggests adaptation is already playing catch-up to potentially substandard practices driven by maximizing short-term yield.
Changes in urban dynamics are an inevitable consequence of significant capital inflow. Yes, but this structural shift provides access to capital that ultimately benefits the broader economy through increased property transfer taxes, infrastructure investment, job creation in property management and construction. The challenge for individual buyers is real, I agree, but it requires adaptation and strategy, not simple opposition to capital. Buying decisions now demand a more strategic, data-driven approach.
And what does that strategic approach look like when you're competing with global funds?
It means individuals must be more sophisticated in their search. They need to monitor market data, they need to evaluate factors like energy efficiency, which reduces long-term costs, and they must be willing to consider alternative locations outside the absolute prime investor targets. If a specific neighborhood is saturated by funds, well, the individual buyer must strategically look at adjacent areas where competition is less severe and better value can still be found. It is a new market reality, not a systemic failure.
So you're effectively telling first-time buyers that if they want to access the market, they have to settle for peripheral or undesirable locations, while the most valuable, well-serviced parts of major cities are permanently reserved for yield maximization. That's not a solution. That is structural displacement.
To summarize my position, this structural shift, evidenced by the staggering volume of over 21,000 corporate purchases in 2025, is undeniable proof of Spain's market stability, its economic maturity, and its successful integration into global finance. This market validation attracts essential capital, it improves liquidity, and it addresses the critical rental shortage. While the challenges for individual buyers seeking purchases in the most coveted areas are substantial, they can be navigated through strategic, informed action and are, I believe, overwhelmingly outweighed by the long-term benefits of robust market investment and a healthier, larger rental sector. We simply can't afford to reject the stability that this capital brings.
And I come at the core issue from a different angle entirely. We have to define what we mean by stable and healthy. The core tension remains that housing in Spain is increasingly being prioritized purely as a financial asset to generate wealth, rather than primarily as a necessary, affordable place for citizens to live. The capital inflow is present, yes, but the true cost is the erosion of accessibility. Individuals face unsustainable structural price increases, that 16.1% increase being the starkest evidence, and competition that fundamentally disadvantages them. This shift risks eroding the social fabric by pricing out traditional homeowners and making market entry an elite or, a generational endeavor.
Ultimately, whether one views the structural shift as a stabilizing opportunity for investment or an existential challenge to social equity, one thing is certain. This dynamic is established, and the institutionalization of the Spanish housing market will likely continue to accelerate in the years ahead.
Right. And it just underscores the absolute necessity for all stakeholders, policymakers, regulators, and individuals to understand these incredibly complex and divergent market dynamics as they unfold, because the future of Spanish home ownership really does hang in the balance.